Welcome to the deep dive. It's Tuesday morning, and if you're anything like me, you probably woke up, glanced at the financial headlines, and immediately felt like you were trying to drink from a fire hose.
Oh, yeah, absolutely.
One minute it's inflation, next it's job numbers, then some arcane comment from a central banker sends markets spinning.
Right. Into a total tizzy.
Trying to predict the market's next move honestly feels some days about as reliable as, I don't know, consulting a magic 8-ball.
Huh. Might be more accurate some days.
The sheer volume of news, the way things can just shift on a dime, it's enough to make your head spin.
It truly is a whirlwind. One moment you're grappling with, a global supply chain thing. The next it's a domestic housing stat. And then boom, everyone's focused on the subtle phrasing in some economic report.
It's immense.
An immense amount to process, yeah.
Yeah.
And the landscape just changes at lightning speed.
Absolutely, and that's precisely why we're here. Our mission with this deep dive is to, well, cut through all that noise, sift through the endless headlines, and pull out the most important nuggets of knowledge and insight for your Tuesday morning. Think of us as your essential shortcut to being truly well-informed, complete with, surprising facts, and we hope just enough humor to keep you hooked and maybe help you connect some dots.
We definitely aim to provide some clarity in what often feels like a perpetually muddled landscape.
Right.
And right now, the market's current vibe is, well, it's a fascinating blend, isn't it?
Yeah.
Anticipation and maybe a slight undercurrent of anxiety.
Yeah, you can almost feel it.
You can almost feel the collective breath being held, waiting for pivotal speeches pouring over earnings surprises, listening for whispers of global shifts that could, reorient everything.
It's a delicate, high-stakes balance out there.
Very delicate.
A delicate balance indeed. And speaking of big speeches and delicate balances, let's unpack one of the week's biggest potential market movers right off the bat. Federal Reserve Chair Jerome Powell's upcoming speech.
Jackson Hole.
At the annual Jackson Hole Symposium, exactly. This Friday, the entire financial world will have their eyes and ears glued to Wyoming, listening for every nuance, every pause, every hint of what the Fed is thinking.
Oh, absolutely. It's a truly colossal event, steeped in history, loaded with market expectations.
Because what Powell says, or even what he doesn't say directly, can send ripples, right? Or even tidal waves across the markets.
Tidal waves is right. And right now, there's a particularly stark warning coming from Evercore ISI that suggests those ripples could be, well, quite significant.
Oh, what are they saying?
Their analysts just issued a pretty alarming prediction. Wall Street could be headed for a rough patch.
Okay, define rough patch.
With stocks potentially retreating anywhere from 7% to a staggering 15% into October.
Whoa, hang on. 7 to 15%. That's not a rough patch. It's like a veritable crater that could swallow your portfolio. What's driving such a grim forecast from Evercore? That sounds huge.
It fundamentally boils down to a significant mismatch. A mismatch between market expectations and what the Fed's likely reality is.
Okay.
The core of Evercore's concern is that the market was, to put it mildly, eagerly anticipating a substantial 50 basis point rate cut. That's half a percentage point.
Right. In September, that narrative was everywhere.
Exactly. It had really taken hold, fueled by hopes of disinflation and, a desire for more aggressive monetary easing to support growth. But Evercore believes Powell is likely to indirectly signal a 25 basis point rate cut at Jackson Hole.
Ah, only 25 basis points.
Just 25. That's half of what many, let's say, aggressive positions of the market were built upon.
So the market was gearing up for a big party, maybe a full feast of easing, and Powell might just show up with half the cake.
That's a good way to put it, yeah.
And that smaller than hoped for slice is what could trigger this big pullback. It makes perfect sense. Psychologically, market expectations are everything. Disappointment can be a huge catalyst for selling, right? Especially when positions are stretched.
Precisely. For a market that has been running quite hot, really fueled by that expectation of more aggressive easing, a more balanced view from the Fed, essentially. A more measured approach to rate cuts could indeed be the catalyst.
A recalibration.
A significant recalibration, yeah. What's fascinating here is that it's not necessarily Powell saying things are bad, but it's that mismatch. What the market wants versus what the Fed feels is appropriate given its dual mandate.
Stable prices and maximum employment.
Exactly. The market has maybe priced in this perfect soft landing with rapid cuts, while the Fed, looking at the data, remains cautious. Given some lingering inflation signals, this divergence, it's critical.
And when we look at that dual mandate, the economic outlook right now is, as Evercore puts it, muddled. Let's dive into that. First, inflation. It feels like we're getting mixed signals louder than a bad radio station, you know?
You're absolutely right. It's confusing. On one hand, the CPI, the Consumer Price Index, what we pay for stuff, rose less than expected in July.
Okay, that's good.
Sounds good.
Right.
Seems like inflation is cooling. But then you look at wholesale prices, the Producer Price Index, or PPI. They climbed much faster than forecast,
Oh, much faster.
increasing by a full 1.2% in July. The forecast was only 0.5%, so significantly hotter.
Oof.
Yeah. This creates a really muddy picture for the Fed. Are price pressures actually easing, or are they just building up further down the supply chain, waiting to hit us consumers later?
It's like trying to hit a moving target with blurry vision for their stable prices goal.
Exactly.
And it's not just prices, right? The labor market is sending equally confusing signals, almost like it's whispering contradictory things. What's going on there?
The employment picture is a real puzzle. On one hand, weekly initial unemployment claims. They've held remarkably steady this year.
Just over 200,000, right?
Right around there, yeah.
Mm.
Which suggests a stable job market, relatively few layoffs. That's a sign of strength. But then you look at the bigger trend. Overall job growth has actually fallen to its slowest 3-month pace since 2010.
Since 2010. Wow.
Yeah, excluding the pandemic shock, of course. So, net job creation is slowing down. Not widespread losses, but slowing creation.
But the unemployment rate is still low.
That's the kicker. The current unemployment rate is remarkably low, around 3.8%, which is about half of what it was back in 2010 when we were dealing with the financial crisis aftermath, and like 9% unemployment.
So fewer new jobs being created, but existing jobs are pretty sticky. People aren't getting laid off in droves.
Exactly. Slow growth, but not a lot of new people losing jobs, and a low overall unemployment rate compared to history. It's a real conundrum.
So how on earth does the Fed balance stable prices and maximum employment with all this conflicting data? What are the trade-offs they're actually grappling with?
It makes their job incredibly challenging. They're trying to navigate this really complex landscape. Do they ease policy to support employment growth, maybe goose it a bit? Or do they hold firm, maybe even tighten, to tackle those persistent price pressures we saw in the wholesale data?
Yeah, every data point pulls them differently.
Totally. If they cut rates too soon or too aggressively, they risk reigniting inflation. We definitely don't want that again.
Definitely not.
But if they wait too long or stay too tight, they risk stifling job growth, maybe pushing the economy into a deeper slowdown. It's a high-wire act. Huge stakes.
And if that wasn't enough drama, we also have some rather prominent political shadows looming over this whole discussion.
Ah, yes. The political dimension.
Which brings us to a particularly sensitive point, doesn't it?
All right.
We can't really talk about the Fed's independence without mentioning President Trump's repeated criticisms of Powell and his constant calls for lower rates, especially since returning to the White House in January.
It's definitely a significant factor, something the markets watch closely, even if they try to pretend they don't. It was particularly unsettling for some economists, maybe adding to the anxiety, is a specific detail from early August.
What was that?
President Trump fired the head of the Bureau of Labor Statistics after a disappointing jobs report came out.
Ooh, yeah, I remember that.
That move immediately raised alarms. Concerns about potential political interference, skewing official economic data.
Which undermines everything.
Exactly. It undermines the perceived independence of institutions like the Fed, whose decisions should be based purely on objective economic data, not political whims.
That's a huge so what, right? If economic data gets politicized, or if the Fed's decisions are seen as anything but independent, based on pure economic calculus, it throws a massive wrench into the whole system.
Credibility, trust, market stability,
Yeah.
it all starts to crumble.
Yeah. The very foundation of data-driven policy. We'll definitely circle back to the critical importance of Fed independence later. But for now, let's get back to Evercore. If this rough patch is indeed coming, how are they advising investors to weather the storm? What's their playbook?
Well, they point to a few more reasons for caution, beyond just the Fed's likely move. First, there's a strong historical pattern. Seasonal weakness.
Ah, the September effect?
Exactly. Their analysts put it quite vividly. Pedal to the metal, equity market bullishness in August typically runs into the realities of September. And historically, September is consistently the worst month for stocks, averaging negative returns in the S&P 500 since, 1950.
So classic sell in May and go away, but definitely avoid September. Got it. What else?
Then there are valuation concerns. Wall Street's recent Liberation Day rally.
Liberation Day sounds dramatic.
Yeah, some strategists coined it. The market felt liberated from, immediate threats of high inflation and rapid rate hikes after some good news earlier this summer.
Okay.
That rally, reportedly fueled by new trade deals and surprisingly resilient corporate earnings, has pushed stock valuations near their highest levels since. Wait for it. The dot-com bubble.
Oof. Not a comforting comparison.
Not really. When valuations are this stretched, any piece of disappointing news, like a smaller than expected rate cut, can have an outsized impact. It can lead to a much sharper correction.
Okay, so historical weakness in September, sky-high valuations, and a potentially disappointing Fed. Recipe for a pullback? What's Evercore's specific advice? What should we be holding, and maybe what should we be running from to minimize this potential 7-15% pothole?
They've laid out pretty clear recommendations. For a core portfolio, they suggest owning what they call AI enablers, adopters, and adapters.
Okay, AI again. Makes sense.
Right. Companies benefiting directly from or integrating AI into their business models, found mainly in communication services, consumer discretionary, and tech.
Any specific names?
They specifically mention big players like Amazon, Alphabet, and Micron as examples. Companies providing the AI infrastructure or rapidly using AI to boost their own products and services.
So stick with the AI trend, but focus on the companies actually making it happen or using it effectively. Seems like a pretty common view right now.
Exactly. The idea is these companies have strong secular tailwinds. They can potentially override short-term market choppiness.
Okay, what else?
And to supplement those core holdings, they recommend attractively priced stocks that have seen positive earnings revisions.
Meaning analysts are actually raising their profit forecasts for these companies.
Exactly. They highlighted healthcare companies like Pfizer and Cigna as examples fitting this criterion. Suggesting their stable demand, strong fundamentals make them appealing in a volatile environment. And maybe their valuations haven't run up quite as much as the big tech names.
Got it. Makes sense. Stable, reasonably priced, improving outlook. And on the flip side, what should investors maybe be selling to fund these buys? Any sacred cows being led to the slaughterhouse?
On the flip side, they suggest funding these purchases by selling pricey stocks with less attractive earnings outlooks.
Okay.
And they didn't shy away from naming names, specifically calling out retail investor favorites like Palantir,
Ouch.
Tesla,
Ouch.
and Snowflake.
Wow. Palantir, Tesla, and Snowflake. That's a direct challenge to the high growth, high valuation story that's dominated, isn't it?
Absolutely. It's a direct challenge to that narrative that fueled so much of the recent rally. Their view is, if the broader market corrects, these highly valued names, whose prices often hinge on significant future growth that might be harder to achieve now, although it disproportionately hit.
Ouch. Those are some truly sacred cows for a lot of investors, especially those who rode that tech wave. But this really frames it as a practical guide, doesn't it? It's not just a warning, it's a detailed playbook. How some top analysts are thinking about navigating potential choppiness, emphasizing valuation over pure momentum.
It absolutely is. It's about being strategic in a volatile environment, focusing on fundamentals, valuation discipline, positive earnings momentum, rather than just riding the wave of popular but maybe overvalued names that might have less support if the market cools off.
A shift from growth at any cost to maybe growth at a reasonable price.
That's a good way to put it, yes.
Okay, from the big picture market view and Evercore's advice, let's zoom in. Let's look at a specific company that just dropped its Q2 earnings this Tuesday morning, Home Depot.
Ah, yes, the big orange box.
A headline here. A slight miss on Wall Street's revenue and earnings estimates, but a steady hand at the helm. They reiterated their full-year guidance.
Right, and this Home Depot report gives us a really interesting window into the current state of the American consumer. It brings up that concept we've talked about before, the K-shaped economy.
Explain that again, the K-shape.
It refers to this sharp divergence in economic experiences, particularly between top earners and, well, everybody else. Some segments are doing great, thriving even, others are struggling, leading to this split, like the letter K, with one arm going up and the other going down.
Okay, let's unpack this K-shape more. How is Home Depot's performance, or maybe the underlying consumer data, showing this divergence actually playing out?
The data is pretty stark, actually. It illuminates this K-shape quite well. While total credit and debit card spending per household, it actually increased by nearly 2% in July year over year.
Okay, 2% increase. Sounds decent.
Sounds okay, right? But that aggregate number hides a crucial detail. A recent Bank of America Institute report noted that spending by higher-income consumers has remained resilient and has been driving growth in aggregate spending.
Ah, so the wealthy are still spending.
Think of them still doing maybe larger renovation projects, furnishing second homes, whatever. By contrast, the report says spending growth of low-income consumers has not been as strong.
Huh?
And this gap, the difference between the high-income and low-income spending growth, is actually the largest it's been since February 2021.
Wow. Since early 2021, that tells a story.
It really does. It indicates that while the overall numbers might look okay, the recovery, or the current state, is incredibly uneven. A large portion of the population is feeling the pinch much more acutely.
So even if overall spending looks all right, it's really being propped up by the affluent while others might be quietly struggling more. That makes those aggregate numbers potentially quite misleading, doesn't it?
Exactly. One part of the economy is humming along fine, maybe even accelerating, while another part is really struggling.
Different segments experiencing things very differently.
Very differently. What looks like overall resilience on paper can mask significant underlying challenges for a lot of people. And Home Depot's numbers kind of reflect elements of this nuanced picture. They cater to everyone, right? Pro contractors, wealthy homeowners doing big projects, but also the DIYer on a tight budget.
Right. So let's get into those Home Depot specifics. What were the exact figures?
Revenue came in at $45.3 billion. Wall Street expected $45.41 billion, so it's a little shy.
Okay.
Adjusted earnings per share were $4.68. The expectation was $4.72, so 4 cents less than expected. A slight miss on both the top and bottom lines. They didn't quite hit the analysts' most optimistic forecasts.
But there's a silver lining here, right? A glimmer of hope, maybe? Especially for the wider housing market? That's been in a slump for a while.
There is a significant silver lining, yes. Despite the slight miss, Home Depot marked a return to consistent same-store sales growth in the U.S. It was up 1.4%.
Okay, just shy of the 1.6% expected.
Just a tick shy, yeah. But here's the really significant part. This is their third straight quarter of positive comparable sales in their home market in the U.S.
Third straight quarter, that's a trend.
That's a trend we haven't seen from them since Q3 2022. So this consistency is being framed as a sign that the prolonged slump in the U.S. housing market, high rates, low transactions, might finally be starting to thaw. Homeowners feeling maybe a bit more confident about doing small to medium-sized projects again.
That's a big deal if the housing market is turning a corner, even slightly. What did CEO Ted Decker say about these results? And what does this momentum really mean in this K-shaped world?
Well, Decker called the results in line with their expectations in the press release, suggesting they kind of knew what to expect given the climate.
Okay.
He emphasized that the momentum that began in the back half of last year continued throughout the first half as customers engaged more broadly in smaller home improvement projects.
Smaller projects, okay.
So maybe not blockbuster growth fueled by new home sales or massive gut renovations, but consistent, steady activity. Smaller stuff.
But is there nuance there?
There is nuance. It's worth noting that under the hood, ticket growth, the average amount spent per transaction was flat.
Flat, okay.
While transaction growth, the sheer number of customer visits or purchases actually fell slightly.
Fell slightly. Oh, yeah.
So that adds a layer of nuance to what momentum really means on the ground. It suggests that while some customers are engaging, the growth isn't coming from people spending more each time they visit. It's maybe just a steady volume of smaller, less expensive projects.
So more small projects, not necessarily bigger, pricier ones. That fits perfectly with that K-shaped consumer, doesn't it? Some feeling flush, others needing to pinch pennies.
Exactly. Makes perfect sense.
What about Home Depot's forward-looking strategy, especially thinking about tariffs and global trade risks?
Well, first, they reiterated their annual forecast. That's a key signal of confidence. They still expect net sales to grow by 2.8% and same-store sales up 1% for the full fiscal year.
Okay, holding steady.
And on the strategic side, regarding tariffs and supply chains, they're being remarkably proactive. They're explicitly not stockpiling inventory like some retailers might do.
Which can be costly and risky if demand shifts.
Very risky. Instead, they are working hard with suppliers and actively diversifying where they get their stuff from.
Diversifying sourcing? Makes sense after the last few years.
Right. Their stated goal is actually quite ambitious. It really speaks to long-term risk mitigation. They said 12 months from now, no single country outside of the United States will represent more than 10% of our purchases.
Wow, that's a very concrete goal. No single country outside the U.S. more than 10%. For a massive global retailer like Home Depot, that's huge.
It's a profoundly significant move.
How does that prepare them for future trade uncertainties? How does it differentiate them from maybe other retailers who might be more exposed to, say, China or another single country?
It's a testament to how seriously major companies are taking supply chain risk now, after all the disruptions. By reducing reliance on any single country, they dramatically lower their vulnerability to geopolitical tensions, trade disputes, even natural disasters hitting one region.
Right. Makes them more resilient.
This proactive diversification could certainly differentiate them. It could allow more stable pricing, more consistent inventory, greater flexibility. That could give them a real competitive edge over retailers still heavily reliant on just one or two countries. It's a long-term play for stability, a fundamental shift in how big companies view their global manufacturing footprint.
Stability is always good. But while Home Depot is strategizing for the long term, there's this fascinating, almost provocative call coming from Bank of America about a much bigger market shift.
Yeah, the Bofo call.
Yeah. They're suggesting that the era of the biggest stocks dominating markets may be done. It's a bold statement, considering how much the Magnificent Seven tech giants have driven everything lately. It's almost blasphemous to some investors.
It truly is a bold call. It challenges the narrative we've lived with for years now, especially since the post-pandemic recovery started.
Right.
Interestingly, Home Depot and its rival Lowe's actually saw their shares move higher in the last month, up around 10%, 15% respectively, largely on that anticipation of Fed rate cuts we talked about.
Okay.
But Bank of America's argument suggests that if the Fed's next move is indeed a rate cut, and if their own proprietary regime indicator is shifting to a recovery phase, then this long run of cap-weighted dominance.
Meaning the biggest companies drive the index.
Exactly. Where the biggest companies by market cap exert the most influence and drive the largest gains, the dominance might actually be closer to done.
Unpack that a bit more. What does cap-weighted dominance look like in practice, and what's their historical evidence for this potential shift away from it?
It's stark when you look at the numbers. Since 2015, the largest 50 stocks in the S&P 500 have outperformed the benchmark index by an astounding 73 percentage points.
73 points.
Yeah. And Bank of America notes the last time we saw such a sustained run of similar outperformance for the top 50 was, wait for it again, the late 1990s, right before the dot-com bubble burst.
Okay, there's that dot-com comparison again. So what happened after that bust?
Well, the market saw a huge shift. Value stocks, small cap stocks, they outperformed dramatically during the early 2000s. Investors looked beyond the tech behemoths for overlooked opportunities.
So Bofi is suggesting we might be on the cusp of a similar tide shift. That's a big if, but if it happens, it rewrites the market playbook for a lot of folks, moving away from just a handful of giant stocks.
Precisely. Bofi's regime indicator, they break market cycles into 4 parts: recovery, mid-cycle, late cycle, and downturn. Their current analysis suggests markets are moving from downturn.
Which is good for mega taps, right?
Okay.
Safety plays.
Generally, yeah. Downturn phase is often positive for mega caps because of their earnings power, strong balance sheets, perceived safety. Investors flock to them.
Okay.
But now they think we're moving into the recovery phase. And historically, a recovery phase typically marked by improving earnings revisions and broad confidence returning. Well, Fed easing in that phase has historically seen mega caps lagging, not leading.
Interesting. So Fed easing in a recovery doesn't lift the biggest boats as much?
Historically, no, according to their model. Plus, they argue higher inflation should also support a broadening out of the S&P 500 beyond just defensive and secular growth stocks, favoring more cyclical or value-oriented companies.
This definitely challenges the whole story we've lived with since, what, October 2022? When this bull market really kicked off, driven almost entirely by large cap tech. The Magnificent Seven pulling everything higher.
They certainly have. DataTrek research highlighted recently. Since October 2022, the top 20 stocks by market cap in the S&P 500, they surged an average of 40.6%.
40%.
While the benchmark index itself gained only 27.9% over the same period.
So those top 20 did all the heavy lifting.
Pretty much. They pulled the entire index higher, while the other 480 stocks were, relatively speaking, a net drag on the S&P 500.
Wow.
So this potential shift Bank of America is forecasting, it would mean a fundamental change, how the market behaves, where investors find returns.
Yeah.
It could lead to a significant reallocation of capital away from large cap tech into other sectors, maybe smaller companies.
Talk about a paradigm shift. Okay, let's pivot again to a corner of the financial world you'd think would be absolutely booming right now, but oddly isn't. Private equity.
Ah, PE, yeah.
You'd think they just got the golden ticket to Willy Wonka's chocolate factory. right? They recently moved a major step closer to expanding into that enormous, $12 trillion plus market for 401k retirement assets.
12 trillion plus, yeah.
All thanks to a President Trump order. That should be a massive game changer.
It absolutely should be. Access to 401k funds represents a truly massive new pool of potential capital for private equity, private credit firms. Potentially trillions added to their investable assets over time.
Trillions.
It's the kind of opportunity that gets entire industries just salivating at the prospect of new fees, new deal flow.
So with such an incredible, seemingly limitless new pool of capital opening up, surely the shares of these PE firms, we're talking the giants, Carlyle, Blackstone, KKR, Apollo, they must be soaring, right? What's the uncomfortable reality?
That is the uncomfortable reality. Despite this vast new market opening up, shares of these private equity firms are actually struggling.
Struggling.
And have been trailing the market badly this year. While the S&P 500 has seen pretty solid gains, these bellwethers of the private markets are lagging. It's a clear juxtaposition. Immense potential versus current underperformance in their public stocks.
What's a real head scratcher? What on earth is holding them back? Why aren't their stock prices reflecting this massive potential influx of capital? It seems like a guaranteed future revenue stream.
The reports suggest that fears of slow sales and tight pricing are weighing heavily on their stock prices right now.
Slow sales and tight pricing.
Okay. Even with the prospect of all this new capital coming in, if the underlying deal environment isn't great, if it's hard to find good deals at good prices, or if their existing assets aren't performing strongly, that creates significant headwinds.
Slow sales meaning difficulty selling the companies they already own, exiting investments.
Exactly. Selling portfolio companies is how PE firms realize their gains and return capital to investors. If the IPO market is sluggish, or if other potential buyers are hesitant because interest rates are high, they can't cash out as easily or maybe at the prices they want.
Okay, makes sense. And what about tight pricing? Does that mean too much money, chasing too few good deals, driving up prices, even for these giants with deep pockets?
Precisely. Tight pricing implies competition for attractive assets is fierce. You've got PE firms, sovereign wealth funds, other big institutional investors, all vying for the same high-quality companies.
Driving up the purchase price.
Drives up the purchase price, which then compresses the potential returns for the PE firms. If they pay too much upfront, even if they manage the company well, it might not deliver that target 2x or 3x return they need over their typical 5-7-year hold.
Right.
For instance, they might find a promising tech startup, but its valuation expectations are just sky high. Even with growth forecasts, the numbers just don't add up to their target internal rate of return, makes it hard to deploy all that capital profitably.
So what does this all mean for us, the listeners, and maybe for the broader market? Why isn't this massive new pool of capital translating into immediate stock gains for these PE giants? Does it signal deeper issues in private markets, or maybe challenges in actually integrating this new capital?
It raises some critical questions about the current health of private markets, definitely. It suggests that even with access to trillions more in potential capital, the market's immediate concerns are about the fundamentals. The difficulty finding attractive assets at reasonable prices, the challenges in exiting existing investments in a tougher macro climate, those seem to be overshadowing the sheer volume of potential funds available right now. It might also signal that integrating these new 401k assets isn't as simple as flicking a switch. There could be regulatory hurdles, maybe a need for different fee structures compared to their usual big institutional funds.
So it suggests the PE world, despite its golden ticket, isn't immune to broader economic pressures, especially higher interest rates impacting those leverage-driven deals they love.
Exactly. They're not immune.
Well, speaking of fundamental economic pillars and the bedrock of America's financial standing, let's turn our attention to the often unsung hero, the Federal Reserve. We just heard about the political pressure it's facing, but let's talk about its indispensable role as America's debt defender and the immense power of its independence. Recently, S&P Global reaffirmed its AA plus U.S. sovereign credit rating with a stable outlook.
Right.
That sounds like good news, right? A stamp of approval?
It is good news on the surface, but S&P immediately introduced a crucial caveat, a condition really, that underpins the entire rating. They made it clear that the independence of the Federal Reserve is of paramount importance for that rating to be maintained.
Paramount importance, wow.
It's not just a nice to have. S&P presents it as foundational. a critical pillar of U.S. creditworthiness.
So why is the Fed so critical to America's credit rating and global standing? What does it actually do to earn such high praise, way beyond just setting interest rates?
S&P's analysis highlights that without the Fed's credibility, flexibility, and stability, and its absolutely crucial role in preserving the dollar's reserve currency status, the U.S. credit rating could be materially lower.
Materially lower. Okay.
Think about the dollar's exorbitant privilege. It accounts for a staggering 60% of global central bank reserves. It's the bedrock of international trade and finance.
Right.
This incredible global financial power, allowing the U.S. to borrow cheaply and influence global markets, is fundamentally enabled by the Fed's independence and its institutional strength.
Yeah.
Their ability to make predictable, data-driven decisions fosters global trust in the U.S. financial system.
That's huge. It's not just about setting rates for Main Street. It's about underwriting the stability of the entire global financial system. The Fed is essentially the world's financial firefighter, in a way.
That's a great analogy. Exactly. The Fed's institutional strength provides considerable monetary policy flexibility that's allowed it to stabilize global financial markets time and time again during crises, from 2008 to the pandemic's early days.
Right.
They are the ones expected to navigate these dual challenges, lowering domestic inflation, addressing financial market vulnerabilities often under immense political and economic pressure. Their ability to act independently, based on economics, not short-term politics, is seen as absolutely essential to their effectiveness, and, by extension, to the U.S.'s ability to borrow at favorable rates.
Yet, despite this critical role the Fed plays in defending America's financial standing, S&P also pointed out some problematic underlying fiscal metrics for the U.S. What are those? Our Achilles heel, so to speak, even with a strong Fed.
Yes, America's fiscal Achilles heel is clearly outlined in S&P's analysis. They forecast the U.S. government deficit will average around 6% of GDP in 2028.
6% average deficit.
Okay, and total government debt is projected to exceed 100% of GDP by 2028.
Over 100% debt to GDP.
These are not insignificant numbers. They represent a long-term structural challenge that could eventually strain the nation's finances, definitely leading to higher interest costs that crowd out other spending.
And to put that in context, how does that compare to other countries? Why isn't our rating much lower given those figures? It feels like we're getting a pass others wouldn't.
Well, let's take Brazil as a comparison.
Yeah.
Its deficit is around 7.6% of GDP, and its total debt is projected to hit 90% of GDP by 2027.
Okay, similar ballpark. Maybe a bit worse on deficit, bit better on debt trajectory.
Right. On the surface, not drastically different from the U.S., but Brazil has a much lower BB rating. That's 7 notches below the U.S. AA+ rating.
7 notches.
And as a result, Brazil pays significantly higher interest, 237 basis points higher on its bonds compared to U.S. Treasuries.
Wow. 2.33% higher borrowing cost.
Yeah. This really emphasizes how the Fed's credibility and independence currently allow the U.S. to borrow at remarkably lower rates, despite facing pretty similar fiscal challenges. The market trusts the U.S. to pay its debts, largely because the Fed is seen as this independent, effective steward, a bulwark against fiscal irresponsibility, maybe.
That makes perfect sense. The credibility of the institution lets us borrow cheaper. Huge advantage. But S&P also noted that America's institutional assessment is below that of some peers due to a lack of bipartisan consensus to tackle the deficit. I mean, we've raised the U.S. debt ceiling, 80 times since 1960? This isn't exactly a new problem, is it? Feels like a perpetual political football game.
It's definitely not new, and it points to a deep-seated political predicament. S&P essentially observes that political polarization leads to sharper policy swings and ultimately the inability of the political class to redress deterioration of the sovereign's fiscal profile.
Meaning?
In simpler terms, as S&P's analyst diplomatically put it, politicians promise too much and spend too much to appease their bases, without a coherent long-term plan to actually fund these promises. This continuous cycle of deficit spending without a clear path to consolidation is a major concern for credit rating agencies.
So this raises a critical question. How does this political dysfunction, this inability to find common ground on managing our finances, directly threaten America's economic standing, even with a strong Fed? It sounds like a ticking time bomb.
It poses a profound threat. If the political class can't effectively manage the nation's finances, it puts increasing pressure on the Fed to maybe step in, potentially blurring the lines of its independence. And if that independence is compromised, S&P's dire warning comes into play. They specifically outlined a downside scenario.
Yeah.
The AA+ rating could come under pressure if political developments were to diminish the independence of the Fed and American institutions generally, infringing on effective long-term policymaking.
And this isn't just theoretical, right? They have an abject lesson for us, a cautionary tale from a country that went down that very road.
Yes, the stark case of Turkey. S&P's BB rating for Turkey is largely explained by what was described as a conveyor belt of central bank chiefs who have been sacked for failing to keep monetary policy as loose as its president would like.
Wow. Fired for not keeping rates low enough.
Direct political interference. It meant the central bank couldn't act independently to curb inflation or maintain financial stability.
And the consequences.
Catastrophic. For Turkey, it meant a catastrophic decline in the Turkish lira, losing over half its value against the dollar very quickly, and triple-digit inflation, prices doubling annually.
Triple-digit inflation. Devastating.
It serves as a powerful, sobering, cautionary tale about the very real, devastating economic impact of compromising central bank independence. Investors lose confidence, capital flees the country, ordinary citizens see their life savings just evaporate.
It really underscores how fragile confidence in institutions can be and the devastating real-world impact for everyday people. So when we hear about political interference with economic data, like the BLS chief firing or criticisms of central bank policies, it's not just political theater.
Not at all.
It has tangible, potentially devastating economic consequences for everyday folks. It connects directly back to that earlier discussion, underscores just how vital the Fed's insulated position is, acting as this impartial guardian.
Absolutely. The perception and the reality of an independent central bank are fundamental to maintaining financial stability, investor confidence, both here and globally. The Turkey example illustrates just how quickly that can unravel when politics overrides sound economic policy. It's a stark reminder that institutions, while they seem abstract, have very real effects on people's lives and the nation's financial health.
All right, let's broaden our lens one last time. Look at the global stage and some key tech developments shaping the market right now. Overall, world markets are generally subdued today, you said, carefully eyeing international stuff and tech news.
Subdued's a good word, yeah. Cautious.
But there's a glimmer of hope on the geopolitical front, isn't there? Concerning Ukraine. A potential breakthrough, maybe.
There certainly is a glimmer. New proposals for a Ukraine-Russia summit have emerged, sparking cautious optimism.
Okay, what's the news?
A significant development. U.S. President Donald Trump reportedly told Ukrainian President Zelensky that the U.S. would help guarantee Ukraine's security in any peace deal to end the war.
Okay, U.S. backing for security guarantees.
Adding to this, Germany announced that Zelensky and Russian President Vladimir Putin would meet within the next 2 weeks.
Wow. A face-to-face meeting between Putin and Zelensky within 2 weeks. That would be huge.
It would be a notable shift, yeah. Even if they're just early diplomatic steps, the very possibility of that high-level meeting is significant.
How did global markets, usually so sensitive to geopolitical risk, react to this potential de-escalation?
The market reaction was quite telling. Subtle shifts in sentiment. The euro firmed slightly against the dollar, suggests maybe a bit more confidence in European stability.
Okay.
Crude oil ticked lower. Often happens with hopes of reduced geopolitical risk, maybe easing supply concerns.
Makes sense.
Gold, the traditional safe haven, edged up slightly, which is a bit of a mixed signal. Maybe some lingering uncertainty about the talks actually succeeding, or just general risk aversion still out there.
Okay. And anything else?
And interestingly, the defense sector surprisingly slipped. Shares of major defense contractors saw a slight decline.
That's fascinating. The defense sector slipping suggests investors are actually pricing in a reduction in conflict or maybe future military spending. That's certainly a hopeful sign, even if cautious.
It signals a cautious but perceptible shift towards optimism. Regarding a potential resolution anyway, investors are always looking ahead. These movements suggest a belief that the risks tied to the conflict could be lessening, or at least getting more contained.
But always caution, as you said, peace talks are complex.
Notoriously complex, yeah.
What?
Can break down easily. Meanwhile, closer to home, U.S. Treasuries have been on the back foot since last week's alarming U.S. producer price report.
Right, that hot PPI number we talked about.
Yeah, that unexpected jump in wholesale inflation. It suggests price pressures might still be building in the pipeline. That's pushed bond yields higher. The 30-year yield is holding just shy of 4.95%. Investors want more compensation for holding debt if inflation might stick around.
Indicates ongoing concern about inflation and what the Fed might do.
Exactly. And speaking of the Fed, Futures, currently priced just over an 80% chance of a quarter-point rate cut next month.
Still pricing in that cut.
Still clinging to easing.
Yeah.
Despite the Fed's cautious stance in that PPI report, it just reinforces that tightrope walk ahead of Powell's Jackson Hole speech. The market wants one thing, the data says maybe something else.
It all comes back to Powell, doesn't it? Okay, beyond geopolitics and interest rates, what's buzzing in the tech sector? Any big updates from the giants pointing to continued innovation, strategic adaptation?
Absolutely. Several key pieces of news show continued dynamism there. Palo Alto Networks, for instance, gave a positive forecast for revenue and profit, beating estimates.
What's driving that?
Driven largely by growing demand for its artificial intelligence-powered cybersecurity solutions, set its shares up 5% in extended trading.
AI and cybersecurity, powerful combo.
Definitely. Shows that AI-driven growth narrative is still very much alive, especially in enterprise sectors like cybersecurity. Using AI for advanced threat detection, automated response, you name it.
Okay, what else? Anything in the crucial chip sector?
Big news for Intel. They received a significant $2 billion capital injection from SoftBank Group.
$2 billion for Intel, wow.
Yeah, being framed as a major vote of confidence for the troubled U.S. chipmaker right in the middle of its ambitious turnaround effort.
They need the capital for those new fabs, right?
Exactly. For Intel, which has faced manufacturing delays, ceded market share, this capital is critical for funding those massive investments in new fabrication plants, advanced chip tech. It's a big boost as they try to regain footing.
And NVIDIA, always making moves.
NVIDIA is reportedly developing a new AI chip specifically for China, based on its latest Blackwell architecture.
A new chip for China, despite the restrictions.
Yeah, designed to be more powerful than the H20 model is currently allowed to sell there. It really showcases their remarkable strategic adaptation to U.S. export controls, their determination to maintain market share in China, which is a critical market for AI.
Finding ways to deliver high performance while staying within the rules. A balancing act.
A true balancing act. They're finding ways.
What's fascinating here is how these tech updates just demonstrate relentless innovation, strategic adaptation, even in the face of market caution and complex geopolitics, especially NVIDIA navigating China. It's a testament to the drive in tech.
Indeed. It highlights how these companies aren't just riding trends, they're actively shaping them, adapting to complex global dynamics, investing heavily in R&D, strategic partnerships to stay ahead.
Yeah.
And to loop back to something fundamental we've touched on throughout this deep dive, consumer spending.
Ah, yes, the consumer.
Its surprising resilience has been such a key reason the economy hasn't just avoided recession, but has continued to grow at a pretty solid clip. It's been the crucial shock absorber.
It truly feels like the American consumer has been the backbone holding everything up, defying expectations time and again. But the looming challenge, as we noted with the K-shape and Home Depot, is whether American households can keep that going, especially with potentially higher tariff-fueled prices coming down the pike.
Right. Those tariffs are essentially taxes on imports. Goods cost more coming in, and those costs often get passed right to consumers.
Which brings us right back to inflation concerns and the ongoing debate about the true, sustainable strength of consumer spending. How much can they really take?
It's the million-dollar question for the second half of the year, isn't it? How much more can the consumer absorb, especially those lower-income segments we discussed, before rising costs really start to curtail their spending? And will those diverging experiences eventually catch up to the aggregate numbers, maybe revealing a broader slowdown? The delicate balance continues.
And there you have it, folks. We've been on quite the roller coaster ride today, haven't we? From the anticipation, the jitters maybe, surrounding Powell's looming speech at Jackson Hole and Evercore's stark warnings, a potential 7% to 15% market pullback if expectations aren't met.
Right down to Home Depot's nuanced earnings, making that K-shaped picture of the American consumer, showing us resilience and struggle side by side.
We also touched on the surprising struggles in private equity. Despite getting that golden ticket to 401k assets, they're battling fears of slow sales and tight pricing.
And we explored the critical tightrope act of Fed independence, highlighted by that stark S&P warning about U.S. creditworthiness and the sobering cautionary tale of Turkey, showing the real-world impact of political interference.
Then we rounded it out with the delicate dance of global events, that glimmer of hope for Ukraine talks, and the relentless march of tech innovation from Palo Alto, Intel, NVIDIA. pushing boundaries even amidst caution.
It's a complex, unpredictable tapestry, isn't it?
It really is. All these seemingly disparate threads, a speech in a picturesque mountain town, the quiet hum of a home improvement store checkout, the high-stakes world of private finance, the geopolitical chess game across continents, they're all intertwined, creating this intricate landscape for our markets. What will the next few days reveal about the true direction of these powerful currents? Will Powell deliver a more hawkish message than expected? Will that K-shaped consumer finally crack under pressure or keep surprising us? The stage is set, the players are in position. But the script for the rest to leak. Still being written. Get ready.